Tendayi, is there a new normal when we talk about some of those further projections and whether or not 2% should actually be the target? And you also talk about that long-term terminal rate as well. Is there this new normal, and what does that then, do you think, mean here for the Fed?
Yeah, I mean, I think the target is still 2%. Even if you wanted to move off of 2%, which I don't think anybody really does want to do that, you can't do it when you're above 2%, right? You can't move the target when you haven't hit the target, because that brings into question, definitely your old target is done, but even your new target now becomes questionable if you're moving targets before you hit it. So I don't think the target moves. I think the Fed will still reiterate that they're focusing on getting inflation back to 2%.
I mean, does any of this, though, change how consumers actually feel right now? I mean, it seems like this, as it continues to be a conversation among households and individuals, and even in the workplace, even if they don't work at a place like Yahoo Finance, where we talk about it in the newsroom every day, inflation is a constant kind of social construct conversation right now.
Yeah, so I think, for, economists, folks like us, we're like, oh yeah, the rate of inflation is coming down. Okay, we're heading towards the 2% target, great. Right, this is kind of what the Fed tells us they're going to do. This is what we expect. This reduces volatility in the economy overall. But the problem, of course, with inflation going down is that the prices don't go back where they were, right? Which I think is the mindset that consumers have, right? They're saying, I used to pay X dollars for this certain item. Now I'm paying, X plus, 0.3 or 0.4, whatever it is, right? So the prices don't go back down. And I think that is what keeps the consumer confidence relatively subdued, right? But when you look at what consumers are telling you, what they say they feel, versus what they're doing, right? There's a huge divergence there, right? So people are actually out there, the consumer's still pretty strong, they're spending, right? We're expecting this quarter, probably GDP is gonna be a little bit stronger than last quarter. So people say they feel one way, and they go out and they do something else.
Yeah, it certainly has been the case here over the last couple of months.
And I would just say the flip side of some of that is, as you're seeing, right, goods, it's starting to come down, right? New autos, right? All you have to do is look at probably your own inbox, right? And we went from them begging for your used cars to now there's sales, there's rebates, all of that. So I think there is some pressure on the consumer, and that's being reflected in lower prices or lower inflation for a lot of goods as that spending's cutting back. And I especially think at the lower cohort, the weaker part of the economy, that spending is starting to slow fairly dramatically.
So, Peter, when you take a look at this print, obviously the Fed is looking at this print as good news here. How many more of these types of prints do you think the Fed needs to see in order to have that confidence for the first cut?
I think this is good enough for them to really start pushing still for a July cut even, right? It's because they do want to get ahead, right? There's these long lag times. They want that. And I think the reality is too, just from a, professional standpoint, you really would not want to make that first cut in September if you can get away with it, right? We're going to be in the middle of the election. Both parties are going to react to any sort of cut. Why not try and get that done on July 31st? Everyone's kind of sleepy. We're not in the middle of the election. So I think this puts us on pace where we're going to get a messaging that July 31st is still in play for a potential cut.
Okay, I was about to ask what the benefit of July versus September is. Thanks for laying that out. I mean, as we're also thinking about, though, the investors that are trying to figure out their strategy here, take us into their strategist hat. What is the first trade? What is the portfolio positioning that you think about after a print like this?
I think you can be very comfortable in fixed income. I think we might see some higher yields. I think we went a little bit low now, and I think we'll drift a bit higher. But, that 5-year and N you like, I really like credit. So in your fixed income portfolio, I really like munis. I like closed-end funds on the muni side where you get some extra juice. I think that's going to be fine. And I think from a risk-taking standpoint, you can start taking more risk. And I think this might start setting the stage for, kind of this rebalancing where the Mag 7 has been such a big driver and everything else has been underperforming, right? I think we're at all-time highs on the S&P 500, but very few stocks are anywhere close to their all-time high. So I want to start looking at those stocks, right? The laggards, and see if they can improve as we go into this rate cut cycle.